Hello and welcome to this session on bookkeeping systems. Hope you find this session useful. Let's now swap over to the questions and make a start. So this session's called Bookkeeping Systems, and one of the important things that we need to recognise are the different financial documents which we first use for certain types of transactions or records that we need to keep hold of. Okay, so usually what happens is there's an initial transaction. That transaction must then have a financial document to support that transaction being entered into the accounts. That will then be entered into a daybook, which will then be entered into the accounts, and then we can extract a trial balance at the end of a period and look at exactly what the balances on all of our accounts are within our set of business accounts. Now, when we're looking specifically at financial documents, we've got a few examples here that we're going to look at, and we've got a few descriptions that we need to match them up to. So first of all, we've got records the value of value of goods being returned when faulty. Okay, so from our options above, this would be a credit note. Okay, so credit notes are suppliers sent some goods to a customer, customers received those goods, and for some reason they're damaged or they're faulty, maybe they're the incorrect goods which have been sent, and they need to be returned to the supplier. The supplier will then issue the customer with a credit note stating that they do not owe the amount for those goods which have been returned. Next, we've got sent by supplier to customer showing outstanding amounts and invoices for payment. So this will be our statement of account. Now, a statement of account is sent by suppliers to customers, usually on a monthly basis, and will just show all of the transactions which are specific to that customer. So it might show any payments which have been made, it might show returns in there, any sales which have been made from the supplier's point of view, from the business point of view, those will be purchases, etc. But all of those transactions within that statement of account. And usually what happens is the customer and the supplier should have matching documents in terms of what's in the supplier's accounts and what's in the customer's account. Records transactions being paid from customer to supplier. So this is our remittance advice. Okay. Remittance advice. So if a customer sends a check to a supplier, they'll usually send a remittance advice slip as well, and this will detail exactly what the check relates to. If a business has multiple invoices outstanding to pay to a supplier, then rather than making separate payments for each invoice, they might just make one payment for multiple invoices. So it's important that from the customer and the supplier's point of view, that they know exactly what that payment relates to so they can allocate it to the correct invoices. We've then got shows details of payments and receipts through a business bank account. So this is a bank statement. Okay, so sent to a business by the actual bank, so Lloyds, HSBC, Barclays, etc. And we'll show them from the bank's point of view all of the transactions which have gone in and out of the business account. What a business will do is check that bank statement against their own records in their accounts, and hopefully everything should match up, but if not, they can look into any differences there. And then finally, a company's return of faulty goods. So this is goods returns note. It's the last option that we've got there. Okay, goods return note. Okay, so when the customer sends the goods back to the supplier, it is the customer that will send the goods return note, and then it's the supplier which issues the credit note. Okay, so we've got a few more to look at here. So we've got Polaris Limited have purchased some filing cabinets from Sirius Co. on credit terms. Which document would be received in the following process? And we've got 4 options. So we've got delivery note, sales invoice, quotation, and goods received note. So first of all, Polaris Limited request a price for 10 filing cabinets. So Polaris Limited here, okay, are the customer, Sirius Co. are the supplier. So Polaris Limited request a price for 10 filing cabinets. So that document would be a quotation, okay, and is usually the first stage within the process. So a potential customer will ask a supplier for a quote on what they're looking to buy. Sirius Co. then deliver 10 filing cabinets to Polaris Limited. So when they send those goods, the quotation will have been accepted by the customer. They would have placed the order. Sirius Co. have now delivered those goods, and they would have accompanied that with a delivery note. Okay, so the delivery note sent with the goods to the customer to clarify that this is exactly what has been sent. Polaris Limited put the 10 filing cabinets into their goods inwards. So that would be the goods received note. So the goods received note, it's an internal document that the customer will use to record those goods being received. They'll acknowledge that they have had those, and they'll keep that stored within their records. And then finally, Sirius Co. request and advise value for payment of 10 filing cabinets. Okay, the final one there, that will be a sales invoice. Okay, now an invoice will be the same document, okay, but it depends on whether it's from the supplier's point of view or the customer's point of view as to whether that's a sales invoice or a purchase invoice. So Sirius Co. are the supplier in this point of view, so they've made a sale to Polaris Limited. So from Sirius Co.'s point of view, it will be a sales invoice, whereas Polaris Limited have bought the filing cabinets from Sirius Co. And because Polaris Limited are the customer and they've made a purchase, the invoice will be referred to as a purchase invoice. Okay, so same invoice, it's the same document, but it may be referred to as a sales invoice or a purchase invoice, depending on the perspective of either business. Okay. So one of the other important things that we will look at is account coding. And what will happen, a business will use certain methods or policies to code within their own system. That could be alphabetical, it could be numerical, or it could be a combination of the two. It could be an alphanumeric coding. So we've got Canopus Limited here operate an alphanumeric system, alphanumeric being letters and numbers, for allocation of customer account codes based on the first 4 letters of the customer's name, followed by a 3-digit sequential number that represents the number of customer accounts. The last customer account code is CAPS 106. So show the next allocation of account codes for the following new customers. Okay, so first of all, we've got Castor Limited. Okay, they're a new customer being added to the accounts on the 24th of January. So we know that the last customer account code is CAPS 106. Okay, so we're going to use the first 4 letters of the customer's name. So this will be CAST, and then the account code being 107. Okay, now from the system's point of view there, what we can say is that that's the 107th customer account that's been added, and that's the system that we'll be following here. So when we look at the next one, we've got Deneb Group. So first 4 letters again, so DENE. There'll be the 108th, so we'll follow their sequence of 108. We've got Graphius Limited, so GRAF, and there'll be the 109th, so 109. We've got Denibola Limited, so DENE and then 110. And then we've got Graphius Company, so again GRAF, but this will be 111. And then finally Casters and Co, so Cast 112. So what we can see there is when we're looking at the first 4 letters, so on the alphabetical part, we definitely have some matching customer accounts there, but we can distinguish between those and ensure that they are unique by following the numerical sequence, by following the number of the account that's added at that time. So it'll always ensure that there's a unique customer account code. Okay, so we're next going to have a look at some double entry bookkeeping, and this is the big part of this unit. Okay, so it's the first unit and you come across double entry bookkeeping. Don't worry if you don't fully understand it at this point. It is something that you will keep building on. There's a whole variety of transactions that you can be dealing with. So really just take your time to try and understand the reasons why and transactions are posted into certain accounts, and we'll have a look through an example here and we'll talk through that. But again, there's so many transactions that you're going to be dealing with. If you don't fully get it at this point now, it's okay, it will become clearer, but it does just take practice and repetition. So Rajel starts his new business on the 20th of July when a family member lends him £15,000 and he also invests £20,000 of his own money. Both of these amounts are banked in the new business bank account on the 28th of July. Rajel purchases a new laptop for the business from the business bank account at a cost of £3,000. How will each of the transactions be recorded in the business accounts? Okay, so we've got 3 different transactions that we need to look at here. Okay, first of all, we've got the family member has lent £15,000. We've got an investment of £20,000 of his own money. And then we've got the purchase of a new laptop for £3,000. Okay. Now, what we do know is that all of these transactions affect the bank account. So we're going to draw the bank account here. Okay. And we're going to post these to the bank account first, and then we'll look at the opposite transaction. So first of all, and I'll match the colour up with the writing to what we've highlighted. So a family member has lent him £15,000 to set up the business. Okay, so what's happened there is £15,000 has been entered into the business bank account. Okay, now the bank account is an asset account, which means it has a debit balance. Now, any asset accounts that, when they all will have a debit balance, any debit entries will increase that balance and credit entries will decrease that balance. So using the bank account as a starting point is useful because we can think of money coming into the bank goes onto the debit side and money going out of the bank goes on the credit side. And then we know that both transactions have to balance, so the opposite entry is posted in the respective account on the opposite side. And the reason that we have to think about the classification of accounts is because we have to work out whether debits or credits decrease or increase balance. Because what will happen is when transactions are posted into the accounts and those transactions balance, the overall accounts will balance. So when we look at the family member has lent Joe £15,000.
Hi there, and thank you for watching the video. If you're new here and passionate about everything accounting, then don't forget to subscribe and give us a follow. We're proud to deliver the best standard of support to our students. We have bespoke study materials, exclusive AAT unit videos, award-winning tutors and so much more. Make sure to follow us on our social platforms to stay up to date with what we're working on. Thank you.